What if I told you that right now, as you watch this video, there are specific cities across the UK where property prices are about to jump, and the window to get in before that happens is closing faster than most people realize? Not in 5 years, not in 2 years. We are talking about the next few months, and if you miss this window, you could end up paying tens of thousands of pounds more for the exact same property. Stay with me, because by the end of this video, you are going to know exactly where to look, what to buy, and how to position yourself before the market moves. Welcome back to NestPath UK, the channel where we break down the UK property market in a way that is honest, practical, and actually useful, whether you are a first-time buyer, an investor, or someone just trying to understand what is happening to house prices in this country. Now, I have been covering the UK housing market for a long time, and I have to be completely honest with you, I do not think I have seen a moment quite like this one. Because right now, the market is sitting at this fascinating intersection. Interest rates are shifting, mortgage products are changing week by week, government policy is evolving, and underneath all of that, there are cities and regions quietly building up enormous pressure, like a spring being compressed. And when that pressure releases, prices are going to move fast. So today, we are doing something different. We are not just talking about the UK housing market in general. We are going city by city. We are looking at the data, the trends, the economic drivers, and we are identifying the specific locations where smart money is already moving in 2026. And I am going to give you the full picture, not just the headline numbers, but the story behind them. Stick around, because around halfway through this video, I am going to share one city that almost nobody is talking about right now, but which every serious property investor I speak to is quietly buying in. You will not want to miss that. Let us start with the macro picture, because before we zoom in on specific cities, you need to understand what is actually driving the UK housing market right now in 2026. First, interest rates. The Bank of England spent the better part of 2023 and 2024 hiking rates aggressively to fight inflation. That caused a real cooling in the housing market. Transaction volumes dropped, mortgage approvals fell, and a lot of sellers who had been holding out started getting realistic about pricing. But here is what is happening now. Rates have started to come down. Not dramatically, not overnight, but the trajectory has shifted. And the moment buyers and investors sense that trajectory, the psychology in the market changes. People who were sitting on the sidelines saying, "I will wait until rates are lower," they start moving. And that demand all floods back in at once. Second, housing supply. Here is a truth that has been uncomfortable for UK governments for decades. We simply do not build enough homes. The target of 300,000 new homes a year has almost never been hit. And with planning permission becoming more complicated, with construction costs still elevated, with labor shortages across the building sector, the supply side of the equation is not going to rescue us anytime soon. What that means for prices is simple. When demand rises and supply cannot keep up, prices go up. That is not opinion, that is just how markets work. Third, and this one is really important, we are seeing a major shift in where people want to live. The pandemic era reshuffling is not over. Remote and hybrid work is now the permanent reality for a significant portion of the UK workforce. And that means people are still making decisions based on quality of life, affordability, and space, rather than just proximity to a city centre office. This is one of the key reasons why certain regional cities are now performing so strongly, and why London's dominance of the property market is genuinely being challenged for the first time in a generation. Now we zoom in. Pay close attention here, because this is where the real value is. Let us talk about Manchester first, because it continues to be one of the most compelling property stories in the entire UK. Manchester has been on this list for a few years now, and I know some people are starting to say, "Has the boat sailed?" And my answer is absolutely not. Manchester's population is growing at one of the fastest rates of any city in the UK. The tech sector there has exploded. Companies that used to feel like they had to be in London are now choosing Manchester as their UK headquarters. And the infrastructure investment is staggering. From Mayfield to Noma to the ongoing transformation of Salford, There are billions of pounds being poured into this city's future. Property prices in Manchester are still significantly below London levels, but the rental yields are strong. The tenant demand is enormous because of the student population and young professional influx, and the long-term capital growth trajectory remains very positive. If you are looking at buy-to-let in the north, Manchester is still very much in the conversation. Now let us move to Birmingham. The second city has had an interesting few years. The Commonwealth Games in 2022 gave it a global spotlight, and the regeneration that was kick-started around that event has continued. HS2. Yes, I know, the project has been battered politically. But here is the thing. Even in its reduced form, Birmingham remains a massive beneficiary of improved rail connectivity. And the HSBC move, bringing thousands of jobs to Centenary Square, was not just symbolic. It was a signal to the entire financial services sector that Birmingham is a serious Tier 1 city. Property in the right Birmingham postcodes, particularly B1, B5, and the surrounding inner ring areas, is still undervalued relative to the fundamentals. That gap will not stay open forever. Leeds, consistently underestimated, consistently delivering. Leeds has quietly become one of the strongest performing property markets in the UK over the last 5 years. It has a massive financial and legal services presence, a genuinely world-class university feeding a constant stream of graduates into the local economy, and property prices that still represent real value compared to Manchester, let alone London. The South Bank regeneration project is transforming the area south of the river. And historically speaking, whenever you see that kind of large-scale infrastructure and regeneration happening adjacent to an established city centre, property values in the surrounding postcodes tend to follow. Leeds is one of those cities where the data and the on-the-ground story are completely aligned. Do not sleep on Leeds. Liverpool. Now this one I find genuinely exciting, and I think it is one of the most underappreciated property markets in the UK right now. Liverpool has an incredible cultural identity, a growing knowledge economy, one of the most active waterfront regeneration projects in Europe, and property prices that are frankly still priced for a city that the market has not fully revalued yet. The L1 and L3 postcodes around the city centre and the docks area offer rental yields that are among the strongest you will find in any UK city. There are risks, as there always are, but for investors who understand the market and buy thoughtfully, Liverpool right now reminds me of Manchester about a decade ago. Remember I mentioned the city that nobody is talking about? Here it is. Sheffield. Sheffield does not have the glamour of Manchester. It does not have Birmingham's political profile. It does not have Liverpool's cultural magnetism. But Sheffield has something that smart investors absolutely love. Fundamentals that are quietly, persistently strong, with a price level that has not yet caught up to them. Think about this. Sheffield has 2 major universities with a combined student population of over 60,000. It has a growing creative and digital economy. It has some of the most affordable housing stock of any major UK city. The S1, S2 and S3 postcodes in particular are seeing real investor interest, not the loud, flashy kind, but the quiet, methodical kind from people who have been doing this for a long time and who recognize when a city is at the start of its revaluation moment rather than the middle of it. Sheffield is that city right now, in 2026. I genuinely believe this is one of the best property opportunities in the UK at this specific moment in time. Now I know a lot of you are thinking, what about London? Because London is always part of this conversation, and it always will be. Let me give you a nuanced take rather than a headline. Prime central London, Kensington, Chelsea, Mayfair, Knightsbridge, is a global asset class. It is not really subject to the same supply and demand dynamics as the rest of the UK market. It is influenced by global wealth flows, currency movements, and international geopolitics as much as by domestic factors. For most people watching this video, that market is not the most relevant one. But outer London and the commuter belt, that is a very different story. There are parts of East London, particularly along the Elizabeth Line corridor, that continue to offer genuine value. Barking, Ilford, parts of Romford. These areas have seen massive connectivity improvements, and the local economies are genuinely improving. And then you have places like Croydon, which has been painfully undervalued for years for reasons that are at least partially now resolving. And Walthamstow, which has already had its moment, but where the ripple effect into the surrounding areas is still playing out. The key principle I would give you for London in 2026 is this: follow the infrastructure. Where transport links are improving, where new employment centres are being created, where young professional renters are moving because they cannot afford the more established areas. That is where property values follow. It has always been true in London, and it remains true today. Let us talk about strategy, because this is what separates the people who do well in property from the people who just get by. The biggest mistake I see first-time buyers and new investors make is buying based on where they feel comfortable, their hometown, the city they know, the area they grew up in, rather than where the data is pointing. Emotion is the enemy of good property decisions. And look, I understand the emotional component. Property is a huge financial commitment. You want it to feel right. But if your goal is capital growth and rental income, you need to follow the numbers, not the feelings. The second mistake is waiting for certainty. Nobody rings a bell at the bottom of the market. Nobody sends you a notification saying prices are now at their lowest. Please buy immediately. The people who make real money in property are the ones who act when there is still doubt in the market, not when everyone around them is confident and prices have already moved. Right now, in 2026, there is still doubt. There are still people saying, I am going to wait until rates come down more. There are still people saying, I am worried about the economy. And that is exactly the environment in which the best opportunities exist. The cities I have talked about today, Manchester, Birmingham, Leeds, Liverpool, Sheffield, these are not speculative gambles. These are cities with genuine economic foundations, genuine tenant demand, and genuine long-term growth drivers. The risk is not zero, it never is, but the risk-to-reward ratio is as compelling as I have seen it in several years. A few practical things to consider as you move forward. Get your mortgage in principle sorted now, before you find a property you love. The mortgage market is moving and the best deals disappear fast. A broker who specializes in investment property or first-time buyers is worth every penny of their fee. Understand the difference between gross yield and net yield. Gross yield is the headline number that everyone talks about. Net yield is what you actually earn after mortgage costs, letting agent fees, maintenance, insurance, and tax. In some markets, those two numbers are very different, and buying based on gross yield alone can land you in serious trouble. And think about tenant demand before you think about the property itself. The best property in a location with weak rental demand is a bad investment. The most average property in a location with fierce competition for rental homes is a much better one. Let me give you my honest read on where the UK housing market goes from here, because I think it is important to be straight with you rather than just cheerleading. I do not think we are heading for a dramatic crash. The fundamentals do not support it. Yes, there are headwinds. Affordability is genuinely stretched in many parts of the country. The cost of living pressure on household finances is real, and the broader economic environment has uncertainties. But the structural undersupply of housing in the UK is a 30-year problem that is not going to be solved quickly. And that structural undersupply acts as a floor under prices in a way that is different from many other asset classes. What I do expect is divergence. The UK housing market is not one market. It is dozens of local markets, each with their own dynamics. And I think over the next 2 to 3 years, you are going to see significant divergence between cities and regions that have the economic foundations to support rising prices and areas where the fundamentals are weak. The cities I have highlighted today are ones where I believe that divergence works in your favor. But this is not universal. There are parts of the UK where I would be much more cautious. The window I keep talking about, the window before prices rise, is not infinite. Interest rate cuts, when they come more decisively, will bring buyers back into the market in large numbers. Supply will not magically appear to meet them, and prices in the best-positioned cities will move. The question is whether you are positioned before that happens or whether you are watching it happen from the sidelines. Here at NestPath UK, we are going to keep tracking this closely. We are going to keep bringing you the data, the analysis, and the honest takes, even when the honest take is complicated or uncomfortable, because that is what this channel is about. Not hype, not clickbait. Genuine insight that helps you make better decisions. So that is the UK housing market in 2026. The big picture, the city-by-city breakdown, the hidden opportunity, and the strategy you need to act on it. If this video gave you something valuable, a new perspective, a city to look at, a strategy to think about, then do me one favor. Hit that like button. It sounds small, but it genuinely makes a huge difference for this channel and helps us reach more people who need this information. And if you are not subscribed to NestPath UK yet, what are you waiting for? We cover the UK property market every single week. New videos dropping regularly. Subscribe and hit the bell so you never miss one. Drop a comment below telling me which city you are most interested in or where you are thinking of buying. I read every single one, and I often base future videos on what you tell me. This is a community, not just a channel, and your input genuinely shapes what we cover. I will see you in the next one. Take care.